Hey, welcome to Money Mavericks. And boy, do we have a maverick with us today, Bob Elliott from the Unlimited Funds. He has been on our show in the past. And I wanted to have a chance to get deeper into what he does, because what they do, nobody else does for the public investor. And, I love Mavericks. And this is being a Maverick. Bob, welcome to the show.
Thanks so much for having me.
All right, so Unlimited, let's get into it. You worked for this little small hedge fund, Bridgewater, only like $800 trillion under management. And then you left to start something that no one has ever done before for the retail investor. Why did you do it? And tell the audience about why it's so cool.
Yeah, I mean, I was at Bridgewater for almost 15 years, and I think I sort of increasingly recognized that the hedge fund industry, it's pretty good for the manager and not that great for the investor. And the reason why that is because, alpha returns are pretty good. The problem is the fees are too high.
Right.
And then if you're a common investor, they're almost always in tax inefficient structures. So you're paying, the highest tax rate possible. And it's typically like kind of a pain to get access, whether you have to fill out paperwork or sort out, are you accredited or qualified or all of those things. And so that got me to thinking about whether we could, basically use technology to infer how managers were positioned and then take that understanding, translate it into long and short positions in, liquid securities and use that to back ETFs. And ETFs are, are well known as being an important innovation around the indexing space. But the thing that's compelling about them with some of the most recent regulatory changes is you can now start to run more sophisticated strategies in the ETF wrapper. And so now we can run things that, do a pretty good job in terms of tracking how hedge funds are trading and positioned, and just be able to do that in a much more low cost, liquid, tax efficient type structure that's available to all investors.
Yeah. And again, let's just assume that our investors or our viewers aren't really hip to all the jargon. So when you say alpha, you're talking about outperformance. And there is a unique aspect to what you do, is that anybody can buy a mutual fund. But in your situation, they're able to get this matrix of all assets, including alternative assets, i.e., limited partnerships or hedge funds or equity funds, et cetera, et cetera. And you're doing all the work, but instead of taking 10% or 15% of all the profits, you guys are rather nice about your prices. Tell me about how much cheaper you are to someone, or how much better return you get by being in the same thing as a hedge fund that charges me 20% of the profits.
Yeah. I mean, that's the big challenge, is that those funds, they not only do they charge a management fee of a couple hundred, 2%, let's say,
2%,
plus take 20% of the profits, plus they'll lock up your money for many years often, right? And so you take all of those things, and instead in the ETF structure, we have a management fee of 95 basis points, which is a lot lower, just flat. None of the profits,
no performance fees,
and I think the thing for many investors that's also important is in a totally liquid structure. An ETF, if you need the money today, you could just sell it. It's just like that. Or you're unhappy with the performance, you could just sell it. I like to say I have to earn people's money every single day, because every single day, right, they can get out of the position or come into the position. That's, so you got it keeps you honest.
Yeah, well, I would say that the interesting part is how many hedge fund managers also own baseball teams. That's really expensive. And Stevie Cohen, obviously he's got a little bit of dough, but if you're bringing in $2-3 billion of fees every year, I can buy a baseball team. I mean,
That's
Bob,
right.
you could buy a baseball team. We could buy football. Now we can't buy football teams, but yeah, I'm with you. So it's interesting to me that when you put your index together, how often do you adjust the weighting of your index?
Yeah, so the index, we're typically looking at aggregate hedge fund indices. And so, for instance, like in our global macro product, that's 500 different managers at any
Mhm.
point in time. And part of what we're trying to do is to reduce what I call single manager idiosyncrasy. Like one of the challenges in the hedge fund business is if you invest in a single manager, your range of outcomes are super wide, which is they could be down 30% or up 30% in
Yeah.
any given year. The other thing that's challenging is just because they are either up or down in a previous year doesn't give you much indication of how they'll perform in the next year. And so what we're doing through
Past performance
indexation,
is not indicative of
it
future
is
returns,
not.
something
No,
like
no, it's
that. Yeah.
actually totally random. It doesn't mean that hedge fund managers don't generate positive returns over time. It just means that their performance relative to their peers is pretty random at any,
Huh.
from year to year. And so by indexing, what we actually do by averaging essentially all those managers together, we create something that's much more, we expect to be much more consistent over time in terms of a return rather than having all that individual manager idiosyncrasy.
Yeah. Well, it is interesting too. Sometimes at a hedge fund, there's a guy or a gal who's just kicking butt, and their desk is doing 60% of the profit for the whole hedge fund, and then shockingly they get an offer they can't refuse to go down the street. Has been my
Right.
experience, or they go out on their own because they've been kicking butt. So then the hedge manager is now looking at his clients and saying, yeah, I know Bob and Bruce left, uh, but we got better people coming in, right?
Yeah,
Yeah,
exactly, exactly. And so that's why you don't want to get you think about hedge funds as like a talent pool, right?
yeah,
There's just all these different, it's not really so much about the individual manager and more around the talent pool. And so you want to own the talent pool. And part of, I mean, I kind of joke about this, like
yeah.
I've hired 25,000 hedge fund managers and analysts. They just don't know that I've hired them, right? By using our technology, right? So we understand how they're positioned. We understand the outcome of all of their work. It's just we don't have
I,
to pay them for all
right.
that
I
work.
hear in my ear, if it feels this good being used, then you can keep on using me, something like that.
Exactly. They don't even know that we're using. Every once in a while, I run into one or two that know that understand what we're doing, and sometimes they can get a little testy about
Yeah,
it.
do,
But
do you do you turn around and walk away and say, "Oh, sorry, cab, taxi, I gotta get to the airport"? All
exactly.
right, so I'm looking at we have a money management business. I'm looking up where we are this year. Um, we were very short before even the Declaration Day or whatever, Independence Day, whatever the hell that turned out to be. How do the politics affect? Because in my vast knowledge, there was no playbook for this at all. And one of the things hedge funds do, or any manager does, is they have a playbook. The playbook
Mm.
has worked for me. It separated me from the other people because my playbook's better than your playbook. And then all of a sudden on Independence Day or whatever the hell it was, no playbook. How do you guys adjust to that?
Well, I think one of the things that's neat about tracking the positions of these managers is that allows you to shift essentially from what is typically most of these managers are systematic in one form or
Yeah,
another,
yeah,
right? To reflect discretionary dynamics. And so, as a simple example, what we saw like coming into Liberation Day when we
yeah.
were all liberated was that managers,
Liberated from $4.5 trillion. But yeah, go ahead.
exactly,
Yeah,
exactly. Macro managers really levered up their gold positioning, like recognizing, I think the playbook at some level was consistent with other highly uncertain, uh, you
yeah.
political events that created geopolitical conflict, right? So I think in that sense there was a playbook, but it's not like any of the macro indicators. Like if you just looked at
Right.
data or something, it wouldn't have told you that this was a good time to buy gold. But nonetheless, the managers came into gold. Gold was their largest position entering Liberation Day, did quite well. And then as gold started to rise, they started to scale back that position, as you should when you start to make money in a position. You shouldn't get too greedy.
Well,
And then interesting,
when you
it,
outperform the market 4x, it's usually a good idea. At home, ladies and gentlemen, if you just happen, like we own GDXU, which is the gold miner ETF, and we like it because it has leverage to gold prices, and they're not discounted at all into the actual value of these miners. Um, and people were saying to me, Toby, what, why is like 13% of my portfolio in gold? I said, because it's freaking kicking butt. You know why? Because in the times of fear and in times of, gee, what the F is going on, everybody else in the world is buying gold. And oh, by the
Right.
way, the central banks, China, EU, UK, etc., were loading up on gold. That's what got us so interested. China just put almost $1 trillion into gold into their central. We're not making that much gold. And so
Right.
the supply demand imbalance was interesting. And yeah, and what we did, it breaks my heart a little bit because I love gold. I love gold, but the miners finally got recognized, and so then they sort of got back to essentially asset value of what the gold that they have. So yeah, you pull back, but that's a perfect example where you saw it before with sophisticated investors, and that allowed you to get ahead of the game.
That's exactly right. And I think one of the challenges, if you're sort of a day-to-day investor, this is a hard business, right? If you're not a professional investor, like it's hard to to have your finger on the pulse of the macro environment and look, for macro managers, for instance, look across 40 or 50 different assets and where are the opportunities. And part of the thing that we're trying to do in the ETF structure is basically here's a one-stop shop where you can basically draw on all that expertise, the wisdom of all those managers, without
Mhm.
having to do it all yourself. I think that's kind of the idea. If you want to sort of add that sort of strategy in, it as a complement to other asset strategies or even
Sure.
your own personal views, it's a nice complement to what investors have in their portfolios.
All right, so let's do the ticker HFGM, I believe.
That's right. Yep, HFGM.
So how did you come up with that one? It sounds like high funicular gross material or something.
Hedge fund global macro
Oh yeah,
is
whatever. Okay.
yep,
So then the other
exactly,
issue
exactly.
is for people at home is talk about what you mean by macro.
Yeah. Macro encompasses a lot of different things, but basically what I'd say is it's investors who, through a variety of different strategies, trade a global portfolio of assets. So they're trading global interest rates, equity indices, typically commodities, currencies, credit spreads, things like that. And so they're not individual stock pickers.
Right.
They're not saying, I don't know, is it Tesla or Meta or Google or whatever. What they're saying is, does the S&P 500 look like it's going to rise or fall? Do U.S. Bonds, maybe the 30-year bond versus a 2-year note, are those going to rise or fall in price? What currencies are the most attractive currencies in the world? Is the yen going to keep falling or will it rise? Those are the sorts of opportunities. And the neat thing about that is I think a lot of folks really focus on like US stocks and let me try and pick the best company in the US stock market. There's often a lot less focus from a global perspective. And so, what these managers can do, because they're flexible, they can go long and short,
Yeah.
a whole variety of different global assets. And that gives a lot of flexibility to find where there are the best opportunities out there.
Yeah, here's a great example. So after our Liberation Day, first off, the dollar has gone down about 10%. And the average investor doesn't know that until maybe they go
Right.
to Europe and they're like, what? Huh? I always love in New York when the dollar would come down against the UK, the sterling at the time. My favorite restaurant, Del Frisco's, because I worked on 49th and 6th, right? I would see these guys, Brendan and his buddy, they would fly over to go have steak at freaking Del Frisco's because, as they would say, it's cheaper to fly and get a steak here than it is in bloody London. And I said that was like to me the perfect macro example. And so if a hedge fund investor can allow you to take advantage, or the other one I was talking about is just German, war making machines. They've just skyrocketed. And oh, by the way, European stocks have not beaten the United States market for how long, Bob? I don't know.
15 years. And
15
actually,
years.
what we saw was that these macro managers coming into the year started loading up on global stocks. right? So essentially looking at non-US stocks is the real opportunity. It's been a good trade, a very good
Oh yeah.
trade, and one that, if you watch CNBC every day, you just like wouldn't think about, they're not talking about how are European and Japanese and UK stocks doing, right? They're focused on, the nuances of
Yeah,
the
well,
US market.
they do when Wilford's doing it, but nobody's watching CNBC EU here unless you're a total nerd, like you.
Right.
So
I'll take that as a
yeah,
compliment.
exactly. Um, yeah, it is intriguing. So now the other thing on hedge funds, of course, is many of them or all of them use leverage. So do you monitor the leverage that these hedge funds have as well? Because hey, when you're levered long and the market's going up, you're the smartest dude on the block. And when it reverses and you have 3 times leverage, you're not the smartest guy on the block.
Right, right. Yeah, I think a lot of times what managers will do is they'll any individual manager will uh, use leverage to express particular opinions. I think um, one of the things that we do in our approach is we're sort of looking at the wisdom of the crowd, and so you might
Okay.
have 10 managers that are levered long the euro and 10, 9 managers that are levered short. And actually the real signal is how those two things net out. And so in our
Oh,
process, we can actually, we don't actually have to take that much leverage because if you just think
right.
about it, most hedge funds in aggregate are running at, somewhere between bond risk and stock risk. And so, there's plenty of risk to be taken from a directional perspective without having to have too much leverage in our portfolio. And so, it's not a big concern that you're going to get squeezed out in one direction or
Yeah.
another.
Well, I found it interesting also coming into the year, the expectations were, oh my gosh, finally we're going to get these corporate tax cuts, and then we're going to get this, we're going to get new spending, and we're going to get a president who likes to see the stock market go up, blah 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 blah, and American exceptionalism, yada yada yada. And according to the data that we get, the U.S. hedge funds were levered more than they'd been in many many years. So when Liberation Day came, I just hate that word now. Uh, they got wiped out. It was March and Call City. We use Morgan Stanley, and I sent a bottle of really good wine from my family's vineyard in Napa Valley, Barlow Vineyards, by the way. And I sent it to one of the guys who gives me this insight, and he said that the average hedge fund in the United States, over 100 million of assets, was levered almost 2 to 1 going into Liberation Day because everybody thought, this after presidential election run up was going to continue, and man, we're going to start deregulating everything and yada. So they said they really had some serious liquidation. Did you see any of that?
Yeah, I think there was some. You probably want to differentiate between equity managers
Yeah.
who, in a lot of ways have been trying to catch up for a long time
Yes.
versus macro managers who have generated pretty good returns, frankly, like in the post-COVID period, like macro managers have, delivered very good returns through a wide variety of cycles. And so it's one of the reasons why, I'm a macro guy by
Yeah.
trade,
Right.
but I also like what they're doing because they've demonstrated. I think part of the thing is the flexibility has meant that they're not predominantly betting on like our equity's going to go up or down, or is Mag 7 going to outperform Russell 2K.
Right.
They're betting on a wide variety of different things. Take for instance the gold run up in the last 18 months. Like they've been predominant, they've been very bullish gold in general over that period with some stops and starts. And so they've been able to take advantage of that in a way. If you're an equity long short manager, you just can't do it. You basically have
Yeah.
to trade the equity market that you see. It does matter which managers you're looking at when you're thinking about that
Yeah,
dynamic.
I sort of think of Greyhound races. I used to work for a company down in Miami. I had never been to a Greyhound, race. Um, it's just hilarious. The dogs are running their asses off, but there's one dog that just beats the other dogs. I don't know. He had better food that day, or he slept better, or something. So, to make that horrible analogy, um, you have a bunch of dogs in the race, and there's ones who are leading. And then do you put more money or behind the ones who are leading and take money away from the ones that are not doing as well?
Yeah, well, I think one of the challenges that folks often have when they're looking at managers is they try and flow money towards the managers that have been doing particularly well in recent periods,
Yeah,
and
recency bias, you mean?
with a big recency bias, and what you and at the cost of diversifying. And the reality is, given that managers don't outperform their peers in any persistent way,
Uh-huh.
and the data is quite clear about that, you're actually a lot better off diversifying than trying to chase manager
Yeah.
performance. And so
Chase the lead dog, as it were. Stay with my analogy, Bob.
I would say the lead dog's performance in one race has no indication of whether
Jason,
they'll do well in the next one.
current performance is not indicative of
It's
future
it's
performance. Yes.
it's like the roulette table, right? They can tell you what numbers have come up, but it is random. Don't tell that to anyone in Vegas, but it is in fact random what numbers will come next.
I'm a craps player. Hard 8, hard 6. They always it always works for me until it doesn't, right?
Exactly, exactly.
I love it. So tell me about performance this year for HFGM, big boy.
Yeah, I mean, we've been around for the product's been around for a little while now, and I think we've been pretty happy with it, up roughly 5% over the course of the last 4 or 5 weeks, and
Okay.
probably even more important with that is having a low beta.
Yeah, less volatility.
Less volatility, low beta, not low correlation to the S&P
Yeah.
500. Because I think when you're trying to build a diversified portfolio, like, look, there's lots of people who will take essentially more equity risk, right? That's not that helpful, right? What you want is something that does well when other things do poorly, or does or isn't necessarily chasing returns when assets are going up. And so I think we've been pretty happy with pretty solid returns. If anything, a little bit higher than you'd expect over such a short time frame. I mean, if we go
Yeah.
up 5% a month forever, we'll be doing pretty well.
Well, then we'd be talking. You'd be in your blimp over
That's
the
right. That's right.
somewhere.
That is. I want to emphasize no promise of future performance.
Yeah.
5% a month.
Well, Bob, it's funny. I brought a family office in. I don't know, late last year, and it's hard for people to understand who are putting their money in every month and building wealth slowly, but who are not you know stupid wealthy. That when you are stupid wealthy, the goal that people bring money to us for is to keep them stupid wealthy.
Right.
They already are wealthy. And so a strategy like yours, like I'm just looking at it. I'm talking to you, and I'm looking at accounts here. All right, we're only down 25 basis points for the day. That this is the type of product for a family who already has wealth, that wants to keep wealth, wants to stay ahead of inflation. But I don't want to look at the freaking thing every day. I
Right.
mean, part of
Right.
the
I mean,
thing about being wealthy is you don't look at it every day. When
yeah.
you're not wealthy, you look at it every freaking day. And then that actually makes your decision making worse. Correct?
Yeah, I think that's right. And it's really about how do you build a good long-term portfolio. And so I think part of that is, having a good balance between different assets, stocks and bonds and
Sure.
gold and international diversification and stuff like that. But also part of it is like find folks who can help you navigate through challenging market environments. And in a lot of ways, that's all we're trying to do here. It's like the biggest institutions in the world have the ability to, have hired the smartest minds to
Sure.
navigate through challenging market environments. And like, why are they the only ones who get to have those investors manage their
Yeah, that's a
money?
great point.
What we're trying to do is just make that available for every investor. And, if you have $20, then great. You can invest $20. If you have 200 million bucks, please reach out. I'd like to discuss further with you, but we're more than
Hey, wait a
happy
minute,
to
you can
take
call
that
me
as well.
too, okay? I mean, I'm an active manager, not this passive crap. All right. So, tell me about income. Do you have an income product that you're going to put together or thinking about?
We're not so focused on income oriented strategies right
Okay.
now. I think predominantly focused on how do we get these hedge fund strategies together. One of the things that is somewhat interesting though is just the nature of the construction, which I won't nerd out too much about. Means that
I know that's hard for you, Bob. I mean,
I know
take a
I'm
deep
holding
breath.
myself back.
Take a
What it
deep
means
breath.
is that most of the profits that will come from this strategy on an annual basis will be dividended out. And so, with a strategy that's got a roughly 15% target return, investors will see a reasonable sized dividend on
Oh,
an annual
interesting.
basis.
Oh, that's cool. I did not.
Yeah.
I feel like Johnny Carr. I did not know that. That is wild. I don't know. I'm into voices today. I don't know. It's probably because I hear them in my head. All right. So you go through registered investment advisors, I assume, and larger broker dealers. How about the average person? Can I just buy HFGM? Is it like minimum $25,000, or are you nicer to people?
No. Minimum, no minimums.
All right.
Available on all your standard discount platforms. So if if you have a Robinhood account, a Vanguard account, things like that, you'll be able to find it. And if anyone, is running into any difficulties getting access, you can always reach out to us. We help people, big and small, make sure that they can find where they can get invested.
All right. Well, here's where the rubber meets the road. What's the AUM, Assets Under Management now?
Well, we've been around for a little over a month with that product.
Oh, okay. Geez.
Our flagship product's been around for almost 3 years.
Yeah.
But the macro product has been around for a little over a month. We got almost 10 million bucks in it, which
I love it. Well,
it
you're
ain't
going to
bad
get a
at
million
all.
bucks from me because I have like 5 people that this is so perfect for.
That's awesome. I
And
appreciate that.
it first off, it makes my life a lot easier.
That's right. That's right. I mean, part of what we're trying to do is make advisors' lives easier, right?
Yeah, I'm an active manager, but again, when you get these large accounts, um, I can't do what you do. I mean, I'm a stock picker. I'm a sector picker, and right now we're still very long the AI tech data center stack, as we like to call it, and all the way down. Down. So when you talk about infrastructure in part of your strategy, is that literal infrastructure, like as in data centers, bridges, power stations? How does that work?
No, I mean, mostly what we're trading is public securities.
Okay.
Is mostly what we're trading in this product, and more generally across our strategies are publicly traded securities, whether it be stock sectors and things like that. In some of our other strategies, or here for global macro, we're really focused on just those 30 or 40 big liquid markets.
Got it. So let's talk politics for a bit. Um,
Sure.
uh, it's not there's not a political show, et cetera, et cetera. However, uh, you can't disregard politics right now if you're going to be an investor, and you do not want to get on the wrong side. I know there's like 3 schools of macro right now in the United States. A, that we're going into stagflation. B, that we're really headed towards a recession. I mean, yesterday, that's the most people I'd heard come out and say, Jamie Dimon, other people that recession is on its way. I always argue that if you understand how the United States economy works, that 63 counties out of 3,300 are responsible for 64% of the entire GDP, that the top 20% of households are responsible for 80% of discretionary spending. And that if as long as our unemployment rate is below 5%, that's full employment in every other economy. So I can't see a recession unless, particularly since when Mr. Trump blinked, as they like to say now, I'm not quite sure his eyes do that, but he blinked. Then I was told by my insiders in D.C. after like 30 years there that Besant, I call him Saint Besant, was the one who came in and said, "Look it, we are going to, when Walmart prices go up 20%, the people who voted for us are not going to be happy. So let's get this 90-day thing, and then maybe do another 90-day thing, and do the voodoo that you do to, negotiate and use all your great negotiating skills. But don't put us in a recession, and don't make Walmart prices up 20%. That's my 2 cents. What's your 4 cents?
Well, I think any sort of let's say open-minded, non-politically biased
Yeah.
person would have came into the year genuinely um, uncertain about what path the administration would take. And I think in a lot of ways there's matching the political coalition. There was sort of a macroeconomic policy two different sort of
Yes.
core macroeconomic policy elements. One was, let's say short-term pain for a better longer-term footing, and that included things like tariffs, high tariffs, plus fiscal consolidation, things like that. And they were really that sort of side could be sort of epitomized by bond market rallies, right? And then I
Yeah,
think
that's a
there's
good
another
point.
side which was much more populist, expansionary, looking for tariffs on the margin, but not really as sort of a central case to restructure the U.S. federal government position. And there it was really focused on deregulation and supporting the
Tax
stock
cuts.
market,
Yeah.
tax cuts, deregulation, supporting the stock market. And I think there was the first couple months, I mean, to be honest, it looked like maybe the first camp was going to be the
Winning.
primary. And I think we've seen an evolution over the course of the last, 4 or 5 weeks that it's really going to be the second. With you look at the tax bill that's going through, look at how tariffs have basically been unwound, significantly. You look at just even the rhetoric of like a focus on you moving from a focus on the bond market to a focus on the stock market. Um, I think I think we can be increasingly confident that it's the second camp that's driving the policy making engine. And of course, there'll be bumps along the way, but the second camp is very different than the first.
Yes, true.
And the
Thank you,
real
Saint Bessent. Thank you, Saint
that's
Bessent.
right. That's right. I mean, it was funny. I was somewhat randomly put on Bloomberg and I was speaking right after Besant did a long form interview, and he was talking. This was right at the beginning. I don't know, it was
Sure.
February or March, I forget exactly. And he was talking about how he wanted the bond market to rally. And the first question that came to me is, what do you think about his statement that the bond market is going to rally? And I said, well, the bond market may rally, but it's probably going to be for reasons that he doesn't really want, right? It's through slower growth, and so
Yeah.
I mean, my guess is that probably won't persist, and so and that's essentially what happened, right? I mean, the market moved very fast to price in low growth, and then the administration blinked and said, "No, we're not doing the low growth thing. We're doing the pro growth thing."
Yeah, it's like my English friends. Hey, wait a minute. Did I say tariffs? I didn't mean that. All
Exactly,
right, so
exactly.
to wind it up, I always think about Ed Yardeni and the bond vigilantes, and then we got the stock vigilantes basically, and now the camps are sort of even here. What we don't have is the Fed, and what you're calling the Fed, because to me, one of the stupidest things a president could ever do is call out, you know, Jay Powell and tell him, what an idiot he is. Because all that does is make Jay Powell use the invisible middle finger, and say,
Instead of the Burr machine, they should have the middle finger meme, right?
exactly, exactly. So what's your call on the Fed here? Obviously we're still really at full employment, and so that part of the mandate is there. Yeah, the bond, a mortgage is 7%, and what did I saw the number yesterday that only 24% of people shopping for houses could afford the average price house. So housing is going to be in the tank for a while. What would happen if the Fed said, okay, all right, listen, we're going to cut 50 basis points. We're going to start to support this. Is that going to make the market go crazy, wonderfully crazy? Or what's going to say, uh-oh, because there's always that thing with the Fed. When there's 50 basis points cut, people like me say, all right, there's something going on here.
Yeah. Well, I think, a lot of ways the Fed is on ice and is likely to
Yeah.
be on ice for a while because just at some level the Fed is a very simple
Yes.
uh decision maker. Like there's a
Binary.
lot of pomp and circumstance and
There's 100
verbiage and
economists
all
down there.
those.
Have you ever been into the Fed? I was in there like 10 years ago. There's not 100. What are 120 economists? Well, how would that help?
I hear you. I hear you.
Yeah.
If Doge could have any benefit anywhere, it would be cutting out the Fed fat. But
Yeah.
that didn't make me many. When I wrote a long thread about that, that didn't make me many friends
Right.
at the Fed. But the I think if you just look at the numbers on their face, like the unemployment rate's been stable for 9 months in the low fours. That's pretty good.
Yep.
Doesn't mean that there isn't some softening and stuff like that. It just means like big picture, the labor market's pretty good. And inflation remains modestly elevated relative to the Fed's target. It's probably on a path to come down, but there's some uncertainty related to tariffs and stuff like that. And so if you're in the Fed's shoes, like, what is the reason to act? Now, to be honest, I don't know what the 500 economists, PhD economists, are doing, because like I just saw, and why there are so many people on the committee and all that. Like, it seems pretty simple. Like,
Right.
unemployment rate's stable, inflation's a little too high. Don't do
I've
much.
become an expert in programming in Python. Because I can just speak into ChatGPT
Yeah, yeah, yeah.
and say, give me write a formula for me that takes the GDP and interest rate and unemployment rate and tell me what the Fed's going to do. It's done. Let's get rid of the
Yep.
other 499 guys. I mean,
Right.
what the hell?
Totally. I mean, they'll never pick me as Fed chair, but the first thing I do is I would fire everyone and create a systematic process that's totally open source. And that would be, there'd be no ambiguity. It would just be, here's how we make our decisions, and that's what it is.
Bob
But
Elliott, Fed chairman. Bob Elliott, Fed chairman. Except he
I
can't
don't.
afford to take the pay cut. Okay. Um, I've known Jay for a long time as a private equity guy, and I think he's the only Fed chairman who's worth like $75 million.
Yeah.
Nobody really talks about that, but I think it gives him ample space to not follow the crowd. I'm
Right.
also interested in the Atlanta Fed's GDP now because it's starting to get really better at forecasting what's going on in the job market. So that's my A part of my Python. B is the federal rate bond rates. What's the biggest fear you have now? I mean, what could F up that come out of the blue or change your thesis?
Yeah, well, I think, of course, you never know exactly what's going to happen with tariff policy. If we were to go back to, there's a reason why markets sold off on Liberation Day rates, which
Yes.
is that they were pretty high, and probably economically disruptive. And so, but that is, in some ways, that's like war risk, in the sense of like, you can't really you don't want to position for war risk, because you will lose a lot of other opportunities that are out there.
That's
But you do
interesting.
have to be aware of it and responsive if it comes. So it's not
Yeah.
like I'm not expecting that, but it is a possibility. I think probably the more plausible risk in this market is that running the economy hot continues to spook bond market investors, and that's not really just a U.S. story. It's a
Sure.
developed world story
Sure.
where we're seeing the long end rise, and so that long end rise would have an effect on asset prices, does have an effect on stock prices and things like that, and so the economy can probably absorb 50 basis points more bond yield rise, but if we start to get much higher than that, then it's going to be a drag, and that'll in some ways will sow the seeds of the reversal.
Yeah.
um
Well,
but
well,
you
well
could
my,
have that happen, and it
yeah.
wouldn't be
Yeah.
great.
My macro is worry is more about the middle finger from China, which owns 21% or 18% now of our total treasury bond. Japan, even Europe. The idea that somehow our dysfunctional Congress is going to come up with some grand plan that doesn't include borrowing another $2 trillion. At the same time, in June, where those 2% 10-year bonds roll over and now they're 7% bonds. That's the one that gets me. We're getting really closer to that point that we've got to essentially print money to pay interest, as opposed to have revenues that are somewhat similar to what our debt payment is. Um, and, and I think that was another thing that Besant got across to Mr. Trump, that if we owned all our debt, we could tell those guys to bugger off. However, since we don't own all our debt, matter of fact, we're the minor owner of our debt, that you can't piss these people off because they have other ways to go now. You can
Right.
actually buy Euro bonds now and get a decent return where before you never could. China shockingly makes more money than it spends. It's shocking. So I was just worried that there was nobody on the rudder, on the till of the good ship United States. And again, I go back to St. Besant, that people came back and said, okay, you understand, the bond market is much more important than the stock market. I know it sounds strange, but do you take bonds up 200% or 20%? That means we have, $4 or $5 trillion of losses. And then you could get the downward spiral, the negative feedback loop. That's what sort of worried me a little bit, Bob.
Right, and I think right the lever is the bond market, and how responsive will the administration be to any concerns that are being expressed by the bond market. And at least so far, I think what we're seeing is, bonds are gently moving up.
Yeah,
And part of that's a reflection of, frankly, like better expected underlying economic conditions, which is kind of a
sure.
good thing. Like that's
Right.
okay. Like you can have bond yields going up as a
For the
function of
right reason.
that. That's a sort of good reason why you'd have
Yeah.
bond yields go up. I think the main question is when and if we start to see those things disconnect. And look, there's a longer term story here, which is like the U.S. kind of regardless of exactly the tweaks of current legislation and stuff like that. There's a lot of debt. We're accumulating a lot of debt. There's going to be uh, bad returns on long-term bonds for an extended period of time. We have a secular dynamic that favors hard assets and stocks relative to bonds as a result. The question is that a well-managed adjustment, or is that an unruly adjustment? Because in one case, it could be actually pretty good for stocks relative to bonds, and in another case it could be actually pretty bad for stocks. And
Bad.
so
Yeah.
that's kind of the question, is how, and it goes back honestly to the two camps we talked about from the political sphere, where if you're focused on having stocks hold up okay, then almost by definition you're going to manage that adjustment in a reasonable way, because
Non-volatile way.
exactly, because the markets will punish you if you don't.
Yeah. Yeah. We learned, I think, from Brexit, what happens when people lose their minds. And I'm reasonably comfortable that these people surrounding the crazy one will keep his feet on the ground, because all you got to do is just show them a little video of Brexit, the 3 days of ultimate terror, and a country losing 12% of its net worth in 2 days. That'll wake you up a little bit. That'll give you the
Yeah.
shock. Now, we're not UK. We were much more diversified, yada yada yada. But yeah, I'm with you. I think cooler heads, to your point, are prevailing, and I think for the right reasons. And there'll be craziness coming out every day. But it, it was interesting to see the first administration. They were all GOP folks. And Mike Pence is, oh my gosh, you couldn't be more GOP. And then this one is, the people part of the gang, and so that had me sort of worried. But I think the market did a great service by selling off 21% in like 4 days, because that said there's repercussions here, real world repercussions. And Mr. President, you don't want to be the president that put us in a depression, right?
Yeah.
Look at me in the eye,
Yeah.
right? Okay. Bob, it's been so great. I love having you. But people at home, HFGM is the new index. You said it's only like 60 days old, 30 days
Yeah.
old.
Yep.
Well, I love it. Well,
It's
I love,
fresh.
actually, I have a strategy that says when a new fund of managers that I respect comes out, they tend to outperform. I don't know what it is. It's just, it happens to be, I've tracked it for more years than you've been alive. And it, new funds usually do better because everybody's like, okay, listen, focus, look at me. We need to we need to show some returns above whatever we can do. But the idea that you can have sleep at night money is what I call it. That is wonderful. And I personally think for people, who are have reasonable wealth here, that I like to have 1/3 of money and sleep well at night type of investments. Um, and then when there is a silly volatility, in fact, now we have money to move in and take
Mm.
advantage of.
Yep.
It's
Yeah.
great. It's great when stocks are on sale in the U.S. economy because of some dipshit thing that somebody did, because that's gonna that will bounce back. The retail investors have been, by the way, buying the dip, as you know,
Yep.
and we have a buy the dip mentality for the retail investment world, which frankly is great for the market, and it's great for their portfolios as long as they can hold their nose and stomach, right?
And keep
So,
buying.
all
Yep.
right, Bob Elliott, the man, the myth, the legend, with the and say the name of your HFGM, because I'm sorry, I can't.
It's just the Unlimited Global Macro Fund. So
Okay.
HFGM, Unlimited Global Macro Fund, available on all the sort of standard platforms. And as I said, if you run into any trouble finding it or executing on it, definitely reach out. You'll know where to find me.
I love it. All right, brother. Great to have you. Can't wait to have you back. We'll talk to you in a couple of months and see how HFGM is doing. All right. Cheers, brother.
Thanks.